A hotter-than-expected inflation report hit the tape. Core numbers came in above forecasts. Right away, markets reacted, yields moved, equities softened, rate expectations adjusted. But reaction is not the same as structural change. This inflation report pressures markets tactically, not structurally. Inflation surprises, they create tactical pressure. They slow the rate cut narrative and they introduce near-term uncertainty. That kind of repricing can produce selling, especially when short-term cycles are stretched. But tactical pressure is not the same as a systemic breakdown. To really determine structural risk, we look at long-term positioning. And those cycles remain intact. Liquidity is not collapsing. Energy is not accelerating. Goods prices are not spiraling out of control. Without those ingredients, inflation pressure, it just stays tactical. Now, let's contrast this with 2022. That was structural repricing. Liquidity contracted, policy tightened pretty aggressively, and those long-term cycles rolled over. But today's report does not show that same kind of deterioration. When structure actually holds, pullbacks tend to become more like digestion. Markets just absorb the data. Volatility rises temporarily, but downside momentum really struggles to sustain. Selling without structural confirmation often exhausts itself. This doesn't mean upside is immediate. Tactical weakness can last days or even weeks. But unless those long-term cycles deteriorate, probability still favors consolidation over collapse. Structure, in the end, determines magnitude. If you're ready to trade with more discipline, clarity, and confidence, predict the market days or weeks in advance, join the Market Turning Points community, and visit stockforecasttoday.com.